We've got just the person to help us take a look at the financial markets here today, the dollar and rates. Paul Nolte joining us this morning, Senior Wealth Advisor, Market Strategist at Murphy Silvis Wealth Management. Paul, good to have you here. Welcome. Let's begin with where I left off, with the greenback in the middle of the range that we've been in all year. What's this telling you?
Ben, that was a great chart, and it was super informative. You're right. It is one of the keys that we take a look at. We are now looking at the dollar breaking some of the longer-term trends. To us, indicates that we've got further weakness ahead to the dollar, so we're now starting to look at international holdings. What's underlying that? The key to that is interest rates, and what we're seeing in the interest rate market has been a much lower yield on both the 10, 30-year, and really the curve as a whole has shifted down from 5% now down to 4.5%. We still have an inverted curve, but that has translated to a lower dollar. So our interest rates are falling faster than everybody else's around the world, and that's leading to a lower dollar. The flip side was true a year ago as we were raising rates faster than everybody else. It translated into a higher dollar. So you have to look at the interest rate market and the dollar as almost mirror images of each other.
Well, let's do just that here. Let's take a look at the interest rates here. We've got yields. I've got the 30-year on the left. I've got the 10-year on the right here. And you can see, again, the recent run-up has stalled out. We've come off. We've got the 30-year, which peaked out around 5%. We're back down to 4.4. You had the 10-year, which topped out at 5.01, and we're back at 4.37 as we head into the open here this morning. And I want to take a look at the dollar here. And give me a second before I take a look at that mirror image, as you pointed to. But right now, I just want to show you how we're basically in the middle of the range, as I mentioned, that we've been in all year. We're going back to the December highs from last year, 107. I mentioned that July low down around 99. But here, let me broaden our time frame out a little bit here, and I think this will show us a little bit more in terms of what you're talking about as far as that mirror image. You've seen, well, we could just focus on this here more importantly. You've got the dollar, which is, again, come off from those highs last fall, September, October, up around 114 here. But a big part of this has been some of the other foreign currencies as well, right? We talk oftentimes, Paul, about the tail that wags the dog.
Yeah, you're right. And one that we look at a lot is the yen, and the yen has been extraordinarily weak all year. It's just hooked up recently, but again, they've had a very easy monetary policy. They've nailed rates to roughly the zero line. So again, interest rates have translated through to their yen weakness in that currency. The same is true in the dollar. Again, ours is stronger because of the higher interest rate environment that we've had. We've now come off of that. We still have decent economic growth, better than the rest of the world. That has translated to a stronger dollar through much of this year, from spring until, as you pointed out, really the last 6 to 8 weeks or so. That's now coming down as we start hearing more from the Fed officials talking about, higher for longer. But I think the markets are anticipating, and certainly when you look at the CME futures, 4 interest rate cuts next year. So a significantly lower yield market. And I think that's what's getting translated now into the dollar.
We've been watching the yuan, which has recovered significantly as well. The yen's a pretty good example of a trade that was a bit overdone, but still in a trend lower type scenario. Talk to us about the Fed minutes yesterday. Paul, anything stand out there? Any surprises?
No, absolutely not. I mean, really, when you look at the Fed minutes this time, it's really, it's old news. We've heard from Fed governors a lot since the Fed last met. And they're all saying kind of the same thing. Hey, we're looking at the markets, we're looking at interest rate, we're looking at the inflation rates, we're looking at the overall economic growth. We're playing this day by day. We're playing it by release. Surprisingly, so is everybody else. We're all looking at it. We're all looking at it very, very closely and trying to decide where the Fed is going to go. And what the Fed is telling you is they're really not sure how much more they should be raising rates, if they should be raising rates. So again, out of the Fed minutes, it really was not much of a surprise, and certainly there was no reaction in the market.
Yeah, it seems like the Fed's unsure. Investors are a bit unsure as well. We've been seeing kind of our positions being taken, right? Bets being placed in terms of expectations. But are you surprised, Paul, to see strength in stocks, the extent that we have? Earnings in many ways have contributed. One could argue the dollar, this rate environment, the pullback that we were just talking about, all very supportive of the run-up we've seen here, holding at or above the October highs in all four of the major indices at this point.
Yeah, the equity markets have been really a surprise. We've gone from 2 standard deviations below short-term moving averages now to 2 standard deviations above. The month of November has been fabulous. It's 7 to 10%, depending upon the index that you're looking at. And everything that's played into that has been the lower CPI, lower interest rates, a little bit weaker dollar, and energy prices coming down here a little bit as well. All of that has played into the stronger equity markets, and certainly we're now back to looking at the technology sector, and that got highlighted by NVIDIA's numbers last night. NVIDIA trading all over the place today, but again, when you look at the tech sector, they have been leading this market higher. They let it lower from the summer until Halloween. They've now let it higher. That can, I think, continue over the next 6 weeks or so as we get through the end of the year. Typically, this is also the stronger part of the calendar into the first quarter. So we would anticipate seeing better equity market. The only wrinkle to that is going to be inflation. And if we cannot get really inflation directionally heading toward that 2% level, we could see some of this start to unravel.
Paul, I want to pull up a couple charts here real quick, which really speaks to the strength we've seen in the indices and the lackluster reaction we saw to yesterday's Fed minutes. I kept hoping that we were going to get another arrow on this chart, another seismic event, right, one way or the other, that we could point to that provided a catalyst. In this instance, it doesn't look like that's the case here. The Fed minutes very well received, and you can see a very limited reaction too. But I wanted to also just pull up this longer-term chart here, and this is the Russell here, Paul, which I'm sure you've been watching, right? Really speaks to how that rally we've seen has been a bit more broad-based. The breadth has been a bit more extended than we had seen earlier this year. VIX has come off. We've seen volatility, a reflection thereof. But, you know, the one thing we're also keeping an eye on here as well as jobs, right? I mean, that's the other kind of area that we could start to see some concerns come into play if the economy starts to falter a bit. If, well, weekly jobless claims even today were to show another uptick ultimately. We were starting to establish a bit of a higher trend there. How closely are you going to be watching the weekly numbers ahead of the more closely watched monthly numbers in the next couple of weeks?
I think the weekly numbers are extraordinarily important to watch. And what we do is we take a look at this period of time versus 3-4 years ago. So we take out the COVID-related weekly jobless claims and we compare similar weeks to prior years as opposed to the most recent trend. We normally see an uptick end of the year, but how does that compare to, say, 4 years ago? And we're pretty much right in line with where we were in 2018, 2019, coming into the pandemic year. And remember, the economy was doing very well at that period of time. So from our way of looking at things, jobs continue to be a very good, very strong, at least at this part of the economy. And again, we see it in the non-farm payroll numbers. We see it in the wage growth numbers. We see it especially on the service side, and maybe not so much manufacturing, but the service side of the economy continues to be very strong.
Paul, final thought. I'm asking all my guests today, how do you approach trading these holiday markets here? We have the session close session tomorrow. You get the half-day session on Friday. This is ahead of the Christmas holidays to come amidst some of the others that are mixed in there as well. I mean, there's going to be some thinly traded days here in the coming weeks. How do you approach that?
Yeah, I mean, today we'll be looking at the economic numbers. We'll probably check out about 10, 11 o'clock and take the rest of the week off and enjoy. And then probably try to get to the club a little bit and try to work off some of the Thanksgiving meal. But when we look at December, you're right, it's going to be kind of those thinly traded days here and there. We do not put a lot of stock in it. We continue to look at the economic numbers to drive. We don't really take big positions coming into the end of the year. We allow the dust to settle, and we wait until 2024 starts to unfold a little bit, and then start to take a look at where we want to be positioned for the coming year.
All right. Jobless claims, durable goods orders. We've got some turkey headed our way, a couple workouts, relax, and enjoy some time off, it sounds like is the plan. Paul Nolte, appreciate you joining us and sharing part of your Wednesday morning with us here ahead of the holiday. Have a good one. Paul's a senior wealth advisor, market strategist at Murphy Silvis Wealth Management.